All right, welcome to all my Rain King Insights members. I also want to welcome those of you from the public. This is our once a month free general market update. So let's dive in. The presentation today is made by Rain King LLC for educational purposes. We got a lot to cover. We're going to talk about the indices. We're going to talk about daily new lows, something called the Bloodbath indicator. Then we'll talk about which sectors are working, which aren't, and then we'll look at some watch list ideas. All right, I'm going to start with the quote of the week, even though I typically put this at the end. Remember that the market is a discounting mechanism. In bull markets, the promise gets the premium. In bear markets, the reality gets the discount. So we'll keep that in mind through the video. All right, let's dive into the indices. This is the S&P 500 on a daily chart. We've talked about the chop that we've been going through for, I don't know, 4, 5, 6, 7 weeks here. It still continues. We've had 3 failed breakout attempts. It's probably also noteworthy that all of the gains from the election day gap up pretty much have gone by the wayside. This week, we've seen a pickup in selling. We're coming down to the lower part of the range that might act as support, but it's also possible we might blow through there and bring us down. A target might be a 10% bull market correction, which would actually be a correction that would bring us below the 200-day, which is this gray line. If we do get an 8 to 12% correction, I call those an intermediate correction, and that type of correction would be enough of a washout to mean we would probably need or would require that we get a follow-through day. Now, if we turn to the NASDAQ here on a daily chart, again, we can see this very gappy and choppy period of uncertainty, whether it's tariffs, inflation worries, Doge activities, etc. It's been choppy, very uncertain in the market with the daily news. The first pullback we got in early 2025 in the NASDAQ took us down almost 7%. But the last 3 days, we've seen a lot of distribution. 3 out of the last 6 days have been distribution. You can see in the lower panel, this is net new lows, starting to accelerate the new lows. Not a good picture if this thing is, we've already broken the support of the range on the NASDAQ, and most of tech is getting hammered. Support level that we might see here is about 10%, just below the 200-day moving average. Things could go further. We might get into this gap area here, which is about a 12% correction. We've been pretty much correcting in time for a while, but now it looks like we're going to correct in price. All right, I want to introduce you to some information on daily new lows, the Bloodbath indicator. So this is a research paper that was done by Ralph Vince and Larry Williams in 2024, and at the CMT Association, it received an award. It's essentially a study of daily new lows. So you might be interested in this paper. It's fairly short. It's only 6 or 7 pages. Here's the web address, and you can go get a PDF of the paper. But there's 3 ways that they talk about daily new lows. One is a climax selling signal. The second signal they flagged is an extreme vulnerability signal. And the third signal is called the Bloodbath sidestepping signal. And that's what we're going to dig into next. All right, so this Bloodbath signal, what they've discovered, or at least their research shows, is that when you get 4% or more on the daily new lows on the New York Stock Exchange, that's the signal. And just to put it in perspective, there's about 3,200 issues traded on the New York Stock Exchange. So 4% is about 128. When they get that signal, their research says you should go to cash or short the market. And what you would do tactically is you get back into the market and cover your shorts on the first day with less than 4% daily new lows. Now, the research shows that from 1980 to November of 2023, they had 630 signals of the 4% or more. The profitable of those trades following this methodology was about 41%. So it's not a huge success rate. So it's really what came out of it is it's not a precise timing tool. But the important part I want to mention is when you get the Bloodbath signal, nearly every market sell-off saw this signal before a major break in the markets. many times leading to bear markets. So what we're learning is the signal could happen a lot. Not a lot, but when it happens, it doesn't mean disaster, but has never been a disaster without this signaling. So really what this does is it puts us on very high alert. So let's look at it. Now, before we dive into the actual indicator, last week I shared information that I thought a good precedent is the 2015 market, which really was a stealth bear market, and talked about how this developed. It was a very choppy year. You can see here, really chopping sideways in a range, dangerous for growth stock traders. And at the top panel, we talked about how the percentage of stocks above the 50-day got weaker and weaker as we went across the chop. And net new highs gradually started to get smaller. You can see the shrinking of net new highs. And then all of a sudden, through the last leg of the chop, you can see net new lows started to really pick up. And then there was a very bad break in the market. So we talked about that last week as something we want to keep in the back of our minds. Now, if we put the bloodbath indicator on, that is the shaded red periods when the indicator started firing during the chop period. So you can see that this indicator started firing, well before we had the bad break. So it's not an immediate thing, but it's definitely similar in 2015, the chop. Now, those of you that are TradingView users, you can get this indicator. It's not my indicator, but somebody coded it, DTRETOLA. So if you want to go to the TradingView indicators and type in bloodbath indicator, you can get this for your charts. That might be interesting. But you can see the bad break we got in 2015. So let's come back to the current market. This is the S&P in 2025. I compared the 2015 market to the similarity of we're going through a choppy sideways period. We've had new highs starting to shrink, and the percentage of stocks above the 50-day has been getting weaker and weaker. So we said we're not predicting anything, but we wanted to keep an eye on this. We mentioned it last week, but let's look at the bloodbath indicator. So when we layer the bloodbath indicator onto the daily chart of the S&P, you can see this indicator has been firing. It started to fire in December, started to fire again in early January. We had a little tick for one day here in February, and it actually turned back on again last week. So we don't know if we're going to get a bad break. This chop might continue on for months, and maybe we break out. But I definitely, I'm bringing this to your attention because this puts us on high alert. When this thing starts to fire a lot, it's potentially could be a bad break coming. So keep this in the back of your mind. You might want to look at this carefully and watch as we see distribution in the market. All right, let's move on to sectors and what they're telling us. All right, so this black line is the XLY, which is consumer discretionary sector, and we're dividing it by the consumer staples, XLP. And the general read that you need to understand is when the ratio is moving up, that means discretionary is outperforming staples. Remember that consumer staples are very defensive stocks. So when the ratio is moving down, such as we had during the bear market, that means consumer staples and defensive stocks are outperforming the discretionary, which is more of a risk-on sector. You'll notice that when we have nice uptrends here in the S&P, the consumer discretionary is also outperforming. You can see it here. You can see it here. So it looked like we were going to start to really get ready to rock and roll here. Consumer discretionary started to really outperform in August of 2024. And we'd like to see that because we'd like to see discretionary helping us with outperformance in a bull market. But over the last couple of weeks, this ratio has really turned down in a very steep way. It's about a 16% drop, while the S&P concurrently is failing to break out numerous times at new highs. So that's concerning. Failed breakouts are concerning. And it's also concerning that consumer discretionary is turning down in a very dramatic way, which might indicate that people are moving into consumer staples. Now, maybe this is a fake out. We don't know yet, but it's definitely something that gets my attention. Now, if we go to a different ratio, let's look at, here's the XLRE. This is the real estate ETF. And a couple of names that are composed in this. There's a lot of names, but here are some of the major names in the index, this ETF. You'll notice that I've also shown the 20-year bond, TLT, in the upper panel. We know that bonds have been going down as interest rates were still creeping higher. Now, if we look at this a little closer, the bonds really came down in this period when the Fed said they were going to put a hold on rate cuts. And you can see that that really is the correlation with the real estate sector. You can see how real estate sector really took a hit, knowing that that interest rates would not be coming down. But things have really turned here in the early part of 2025. The XLRE has been rallying all of 2020-25, and you can also see that bonds looks like they may have bottomed. Maybe that means rates are going to start coming down in the future. So it's really interesting to watch this because the relative strength of XLRE is showing a new high before price. So you might want to have this on your sector charts in terms of where there is relative strength. Now let's turn to the semiconductor ETF, SMH. Now I've been talking about this off and on for the past 6 months, how it's so important to the bull market. And, we really broke down about a month ago. Then we had a little weak rally here, but all of a sudden the selling is really picked up. You can see the volume down here, heavy selling in the sector. And really it's completing a head and shoulders top. Here's the left shoulder, head. There's been multiple right shoulders, and we're breaking down right now. And who knows what happens next? Maybe we get a climax of selling that just washes out the chip sector completely and it starts to rebuild. We don't know, but we do know is the king of the chips, NVIDIA, reported their earnings on Wednesday, and they had a very, very good report, earnings and sales. And the disappointing part about that is it did not help the market and tech stocks at all, which is a very negative sign. And I had put out a tweet the day before earnings of how important it was to see if NVIDIA could pick up the tech sector. But I noted that, NVIDIA itself has been under complete distribution since June of last year, and institutions are looking at any rally or positive news to distribute their shares. So this is a bad sign for the market when chips and the king of the market has really not been able to get a rally induced. So let's turn to Watchlist Ideas. Last week, we broke down some of the leaders that we saw in early January, and we came back to those leaders to do an update on them last week. And I've listed a bunch of leaders, a handful, and we looked at, you can see the comparison. All of the red charts that are shaded are basically deterioration in the leaders, and I broke this down in a much more detail last week in our video for the members. But you can see that many of them are well off their highs. Accumulation distribution ratings are turning to season Ds. And we talked about failing breakouts, breaks below the 50-day, relative strength lines that are really breaking down. So it was not a good sign. And this week, we've just seen more confirmation of that. So I just put this mosaic together. There's a lot of damaged charts. These are daily charts, little mini charts, but they're daily charts. And we are seeing bad breaks through the 50. We are seeing heavy volume selling. We're seeing any rally attempts turn out to be very weak rally attempts and rolling over relative strength lines. So you can see from Tesla to Vertiv, the mosaic is showing a lot of damage across particularly the tech sector, whether it be AI related, infrastructure related, even the software names are also taking it on the chin. A lot of damaged charts, and that's usually going to take months to repair this kind of damage, technical damage. So where do we look? Well, we can try to look for watch list names that are showing relative strength. And by relative strength, they're probably holding key levels such as the 50-day, maybe the 20-day. They have very muted selling amidst the sell-off in tech stocks. Some of them are actually building bases, or they have strong relative strength lines showing that they're holding up. So I just put this mosaic together. These are a number of names that so far are holding up. Things like Viking, even Rocket Mortgage, which is an interesting one because this is really an interest rate play. If this can, it's showing strength in the last couple of weeks, which might mean interest rates are forecasted to come down sometime soon. You can see a lot of other stocks, some have had gap ups. They're still holding 20-day, like Brothers. So look at the stocks that are forming bases that are above their 50-day. Here's a good crop of names to put on your watch list, at least at the early look at trying to find relative strength. So when you're developing your watch list, there's probably three ways to engage. One, as I mentioned, keep a track of all of these stocks that are showing strong relative strength in the growth areas. Like I said, many of them are starting to pull back to support areas, and if they hold, that's a really good sign to keep them on your watch list. Some of them are already in bases, so watch the right side of those bases to see if they're healthy and they're showing accumulation. Or you can also just look for sectors that are showing relative strength, like XLRE and some other sectors. And if you're willing to play non-growth names, you might move to those sectors and try to find a position. Or the third totally acceptable thing to do right here is just be disciplined and sit out. Wait for a clearer picture. Given if you're a growth stock investor, and you've been pushed out of your positions and really have come close to being 100% cash or a little bit exposure, you might just want to sit out. The picture is very unclear right now, and we're seeing some new lows that are increasing and accelerating. That's not a good sign. So maybe it's best thing to do is just to sit. Okay. Now I broke this down in last week's video, so I'm not going to go over this in great detail. Those of you on the public viewing, you can break this down and pause your video player. But the market environment conditions have changed over the last 3 weeks. You want to be patient here. Usually we get 2 to 3 good rallies a year, so you have to be patient. You got to adjust to the conditions. We talked about trading ranges are the most dangerous things for trend followers, and that's what we are, growth stock trend followers. You can't be sloppy about taking positions. Initiating positions in a trading range can be very, very dangerous to get cut up with a lot of little losses. So you don't have to engage, you just really have to be building a new watch list. It's very important. We mentioned about maintaining your confidence and also managing any drawdowns in your account, because we want to wait for the right pitch. And clearly the market conditions right now are not very conducive to growth stock investors. So in summary, the S&P is only off 5%, but if you look at tech, the Qs have come off very sharply, over 8% the past 7 days. So that's just showing the wreckage under the surface. The power trend is off, and I mentioned before, new lows are accelerating. The bloodbath signals are starting to build up. We don't know if they'll clear themselves or if something worse is coming. So we need to be on high alert. Former leading charts have gotten very, very damaged. It's going to take weeks to months to repair those and build new sound bases. This is really a bad sign. The leaders have been rolling over left and right the last 2 weeks. So that's not a good sign. So exposure levels, which were largely reduced in a big chunk last week, I see back down to 0 cash as a position or to 25% exposure. And if you are exposed to the market, it really should be only names that you have a very large cushion in, that you have conviction that you want to hold to a potential base that could be 20, 30% deep. Under the surface, there's a lot of wreckage. Who knows if the indexes are going to follow? I would really, really caution about initiating any new positions as a growth stock trader here. And who knows, shorting opportunities may develop. We'll talk about how to short and shorting opportunities with Rain King members next week. All right, back to the quote of the week. The market is a discounting mechanism. In bull markets, the promise of future earnings is what gets the premium. But in bear markets, the reality gets the discount. A lot of uncertainty out there. So have your risk controls in place, and be very cautious in this environment right here. It's not a time to be aggressive. All right, that's the general market update for February 28th, 2025. Those of you that are not part of Rain King Insights, please take a look at rainkinginsights.com. We are a growth stock investing educational site. I do my best to educate traders that are interested in growth stock investing, whether we have 0 years of experience or more than 10 years of experience. We have something for everybody on the spectrum to make you a better growth stock trader. Thanks, everybody.